Hey everybody, is stock market volatility good or bad for you? And when does it turn deadly? Last Monday, August 5th, the S&P 500 experienced one of its worst daily performances since 2022, followed promptly by one of its best daily performances, okay? If you still have that pain in your neck, it's the whiplash that you got from last week's stock market volatility. We're talking major volatility. Let's take a look at the S&P 500 index graph and take a look at the numbers, okay? So this past Friday, like just on the 9th, the S&P 500 closed at 53.44. Now that's just up just a little bit, 2 points from the Friday before that, okay? But look at the crazy volatility ride during the week. This is what was so tough to stomach for so many people. See here on Monday, the S&P 500 was down 3%. So the sky was falling, right? It was panic mode almost. Then on Tuesday, it recovered. It was up 1%. Wednesday, down 0.77%. Thursday, up 2.3%. And then Friday, up 0.47% to just about break even for the week. But holy cow, what a crazy volatile week. So in this video, we're going to answer the question whether stock market volatility is good or bad for you and when can it turn deadly. We're going to do that by looking at three things. Numero uno, we're going to look at Warren Buffett's enormous recent stock sale and his record cash position to see what we can learn from him. Remember, he's the Oracle of Omaha and one of the world's greatest investors of all time. Two, we're going to look at scientific research on the adverse health effects of what I'm calling the volatility virus to determine when it turns deadly. And three, we're going to take a look at a 7-step therapy to prevent and cure the side effects of the volatility virus so you can win your money games and achieve financial freedom faster so you can enjoy it longer.
So, huddle up team. We are John and Tara Thorman, your financial success coaches, and we help entrepreneurs, influencers, business owners, and self-employed professionals achieve financial freedom faster so they can enjoy it longer. And we would love for you to join our team by subscribing to the channel and crushing the bell icon.
That's right.
And the like button so you'll never miss a video.
Now, let's take a look at the recent money moves from Warren Buffett. After selling over 50% of his position in Apple just this year, in the last 6 months, he's sitting on a record high $277 billion, with a B, $277 billion of cash. Now, here's the thing. He doesn't like sitting on cash. He wants to invest that money so he can make even more money. But at the moment, he's quite content earning 5% on his T-bills. Buffett has dramatically increased his cash position over the last year. His company, Berkshire Hathaway's, held $97 billion in T-bills 1 year ago, but now it has $234 billion. Now check, this is mind-blowing, okay? That's more than the U.S. Central Bank owns. Can you imagine that?
No.
Berkshire Hathaway owns more in T-bills than the U.S. Central Bank. The Fed right now owns $195 billion in T-bills compared to Berkshire's $234 billion. Almost inconceivable. So what the heck is Warren Buffett thinking? Since the end of 2023, Buffett sold approximately 56% of his position in Apple, most of it in the second quarter, and yet it still remains his single largest stock position. So why did he sell Apple and raise so much cash? Well, he didn't consult me on this, so I don't know for sure. But I am available, Warren, if you want to talk about future trades, okay? But I think it's safe to assume that there could be a few motivations, so let's take a look at them. First, perhaps he felt that Apple's share price was overvalued, and now would be a good time to take some profit off the table. Seems reasonable, right? Second, perhaps his position in Apple had grown too large, and his target asset allocation model was out of whack. It was just time to rebalance his portfolio. Third, perhaps he felt it was a good time for some sector rotation, right? Move out of all this heavy IT sector and go into a sector that might have some more upside potential in the short term. I don't know, but maybe Warren Buffett has a sense that a perfect storm is brewing. And as a result, he wants to have a huge cash position so that he can pounce when the opportunity is right. I mean, he is a value investor after all, and that's exactly what he did in 2008 during the Great Recession. Companies tanked, and he came in and bought great companies at super cheap prices and made a fortune. For Warren Buffett, I think we can agree that volatility is a very good thing. He loves it because it gives him great buying opportunities. What do you think Warren Buffett's primary motivation is, though? Let us know in the comments down below if you have an opinion. Now, let's take a look at the science surrounding the volatility virus that I mentioned earlier. Recent research shows that periods of increased stock market volatility brings adverse health reactions, hence what I'm calling the volatility virus. In an article titled, "Stock Volatility Increases the Mortality Risk of Major Adverse Cardiovascular Events and Suicide." That's a mouthful, right? The article showed a high association between stock market volatility and increased mortality from heart attacks, strokes, and suicide. I'll include a link in the description box below so you can go and read the paper yourself. So the science shows that for some people, stock market volatility can actually be deadly. Now, who are those people? Well, the excess mortality risks occurred on the day of the volatility and persisted for 2 days afterwards. And they were greatest for suicide and hemorrhagic stroke. And the excess mortality risks were more pronounced among males. That's not good for me. Age 65 and older. So far, I'm better. And those with lower education levels. Okay, I'm good. I'm educated. But for this study, it was found that those with lower education levels and those lacking investment knowledge tend to engage in irrational behavior and expect disproportionate returns from the stock market, thereby amplifying mental stress from stock market volatility. Furthermore, they observed a significantly greater excess mortality risk of suicide during the warm season. Yikes! This is the warm season. It's the summer here in North America, right? So from the study, we see during the summer months, men over 65 who possess little investment knowledge are at greater risk of dying from stock market volatility. And I'm just following the science, okay? That's what the research is showing. So that makes stock market volatility very bad for a lot of pre-retirees and current retirees. The first step for that group of people would be get a financial coach and get some financial education, okay? Learn more about personal finance and the markets and investments. Finally, to answer the question, is volatility good, bad, or deadly? Let's look at my 7-step therapy for everyone to effectively prevent and treat the volatility virus so you can get back to winning your money games. To answer the question, is volatility good, bad, or deadly? We must first realize that there are no perfect solutions. There are only trade-offs. And there is no such thing as one-size-fits-all financial advice because that fits nobody at all. So the answer to the question is really, it depends.
Right.
And you might hate that, but it's true. It depends because you're unique and your situation's unique. So let's run through. I have 7 it depends statements. And we're not talking about incontinence here, okay? 7 it depends statements, whether the volatility virus is going to knock you out of the game or not. Numero uno, it depends on your level of financial awareness. Are you paying attention to your investments? Are you watching the market? Now, we don't want to go to extremes. I want to prevent you from being obsessed and watching the market, every single hour of the day. But I also don't want you to ignore it for extended periods of time. Neither of those is healthy and good for you.
And it depends on your level of financial education. Prevent the volatility virus by getting a solid education in personal finance and commit to continuous learning and improvement.
Very good. Number 3, it depends on your level of emotional stability and control, right? Prevent the volatility virus by working with a financial coach and improve your mental toughness. This requires you to be physically fit, mentally fit, spiritually fit, and financially fit.
And it depends how clear you are with your financial goals. Prevent and treat the volatility virus by reviewing and setting both short-term and long-term financial goals.
That's good.
Get clear on the amount you want and the date you would like to have them achieved, and then practice visualization to see yourself achieving them and feeling the experience of achieving it.
That's so good. All right, number 5, it depends on your asset allocation and diversification. So prevent and treat the volatility virus by looking beyond Wall Street for solutions. Asset allocation is not 60% stocks and 40% bonds, okay? That's archaic, right? Rather, it's investing in 7 to 8 different non-correlated asset classes and then diversifying the holdings within each class into different sectors and different geographies and different companies.
It depends on your investing and trading strategies. Prevent and treat the volatility virus by expanding beyond the conventional buy and hold philosophy with passively managed mutual funds and index funds. Add actively managed investments that offer improved risk management and leverage by using options and futures.
That's right.
Start small, maybe 10 or 20% of your portfolio, and increase it as you gain experience and improve your mindset, skill set, and tool set.
Love it. Perfect. Yeah. Number 7, it depends on where you are in your financial game plan. So prevent and treat the volatility virus by understanding what game you're playing and where you are at in that game. So are you winning or losing your finite money games? And are you ahead or behind in your infinite wealth game? If you take a look at this financial game plan slide, you can see, are you in the first quarter of the game, which is the accumulation phase? Or are you in the second quarter of the game, which is the preservation phase? Third quarter is decumulation, fourth quarter is wealth transfer. I mean, you've got to run different plays depending on where you are in the game. So, is volatility good, bad, or deadly? As you can see, it really depends on you, right? It's up to you. Volatility can be good during your accumulation phase. When you're young, it's early in your investment lifespan, and you can take advantage of dollar cost averaging, right? Whenever the market goes down, when it's volatile, you can buy more shares for the same amount of money. That's good. Or you can benefit from volatility if you're trading and you can take advantage of the price movement in the stock that you're buying. Volatility is bad, however, if you're in your decumulation phase, because that means that every time you need cash flow, you end up having to sell more shares to generate the monthly income you need when the stock prices are low. That's bad. We call that dollar cost ravaging, because it'll gobble up and destroy your nest egg before you know what happened. It's also bad if you don't have a solid financial education and aren't working with a financial coach or advisor that can help you stay the course and follow your disciplined financial game plan. In extreme cases, the volatility could kill you. So what are you going to do with this volatility virus treatment program? Again, it's up to you. But let us know in the comment section below how this has helped you and what you intend to do differently so that you don't succumb to the volatility virus. In this video, we hope we brought you a lot of value. If you thought so, would you please like the video and drop a comment, and be sure to subscribe to our channel. We want you to join the team, be on this journey with us, and never miss another video, because you don't know which one could change your financial life. We're here because we want to help you win your money games so you can achieve financial freedom faster, so you can enjoy it longer. See you on the next video.
Good show, hon.
Thanks, babe.